The Ontario Teachers' Pension Plan, OTPP, one of Canada's largest and most influential investors, has made a dramatic move away from the US dollar this year, slashing its exposure by 56%. The shift comes as the Canadian dollar, the loonie, surges and concerns mount over President Donald Trump's renewed trade war rhetoric and heavy spending economic plans. By the end of June, OTPP's net US dollar exposure had fallen to 40.2 billion Canadian dollars, 29.2 billion US, its lowest level since mid-2021. That's a sharp drop from the 91 billion Canadian held just 6 months earlier. Most of the pension's overall reduction in foreign currency holdings, down from 142 billion Canadian to 99.4 billion Canadians, came from trimming US assets. Before we dive into the details of this news, we'd like to ask a quick favor. If you haven't already, please like this video and subscribe to the channel. It helps us continue bringing you in-depth coverage and analysis. Thank you. And now let's get back to the discussion. OTP executives say the decision was driven by market realities. The US dollar has been a headwind for all Canadian domiciled investors this year, said Stephen Malenin, OTPP's chief investment officer for asset allocation. We've adjusted our expectations not only for this year, but for the next several years. The Canadian dollar has been one of the world's stronger performers in 2025, climbing more than 5% against the greenback in the first half of the year, its best opening half since 2016. In contrast, a Bloomberg index tracking the US dollar has fallen about 9% in the same period. Analysts point to the disruptive effects of Trump's aggressive trade measures, tensions with key trading partners, and investor concerns about ballooning US government spending. For Canadian pension funds, among the largest holders of US assets globally, currency swings can have an outsized impact. When the US dollar weakens, returns on American investments shrink once converted back into Canadian currency. To protect themselves, big players like OTP use currency hedging strategies, and in this case have taken the additional step of reducing their US dollar holdings outright. Market analysts at TD Securities and JP Morgan warned that more Canadian pensions could follow OTP's lead, increasing their hedging and repatriating funds, which could in turn put additional downward pressure on the US dollar. Increased US dollar hedging and potential repatriation pave the path for the dollar to keep moving lower sustainably for the next couple of quarters, TD's Jyoti Baraj said in a recent report. OTP's CEO Joe Taylor described the fund's positioning as cautious compared to some peers. We've been very thoughtful about the risks we wanted to take through this period. I guess you'd see it as a bit more risk-off in terms of our investment choices. The message is clear. In an era of unpredictable trade policies and political volatility south of the border, even Canada's biggest investors are rethinking how much exposure they want to the US dollar. Beyond Ontario Teachers' Pension Fund, other Canadian pension heavyweights are also reevaluating their US exposure amid growing geopolitical uncertainty and volatile US policy. The Canada Pension Plan Investment Board, CPPIB, which manages hundreds of billions, has begun reassessing its involvement in US private market assets, a move prompted by concerns over losing tax advantages and rising instability in US policy. At the same time, media reports note that CPPIB's exposure to the US equity and bond markets remains significant because its portfolio depends on global diversification to buffer against domestic demographic and economic shifts. Meanwhile, the Caisse Depot A plus Quebec CDPQ is also recalibrating its global allocation. Though the US still accounts for around 40% of its portfolio, the fund plans to shift some investments toward Europe, especially the UK, France, and Germany, particularly in infrastructure and energy transition projects. In addition, Canadian investors with real estate exposure to the US, such as OMRs and CDPQ, are showing increased caution in the face of political tensions and US trade threats, which have already caused deals to stall and raise concerns among industry leaders. It's worth noting that Canadian pension funds have long been major investors in the United States, although this was not always the case. For much of the 20th century, right up to the 1980s, most Canadian public pension plans invested almost exclusively in domestic government bonds. These funds operated on a pay-as-you-go basis with little independent oversight and had yet to adopt the modern governance and diversification strategies seen today. Starting in the 1990s and continuing over the following decades, Canada developed what's now celebrated as the Canadian model of public pensions. This model is characterized by arm's-length governance, professional in-house asset management scale and diversification across geographies and asset classes, including a growing share of foreign investments. Backing this shift, the Canada Pension Plan Investment Board, CPPIB, was established in 1997, began investing in 1999, and moved quickly into equities and private markets, including U.S. assets. By the early 2000s, CPPIB was already funneling significant capital into broad equity indices like the S&P 500. As of 2025, historical data shows that CPPIB held nearly half of its portfolio, 47% in U.S. investments, up from 42% in 2024 and 36% in 2023. That increase was driven by stronger 5-year performance of U.S. assets compared to Canadian holdings, 9.6% versus 5.8% returns. Meanwhile, other Canadian pension players have steadily reduced their exposure to U.S. private assets. In early 2025, some funds signaled they were halting or reconsidering new U.S. private equity deals due to concerns over losing tax benefits and uncertainties created by U.S. policy shifts, including unpredictable trade and tariff moves under Trump. Moreover, Canada's U.S. real estate investments, extremely substantial over the past decade, have come under pressure. Since 2015, Canadians have invested around $184 billion in U.S. real estate, the largest international share. But mounting geopolitical tensions and provocative rhetoric under Trump have raised red flags, prompting major funds like OMRs and CDPQ to consider diversifying away from U.S. real estate. One of the clearest snapshots comes from an April 2025 Writer column, noting that foreign investors, including Canadian and European pension funds, have begun reducing their exposure to U.S. assets. Their caution stems from rising U.S. policy unpredictability, which challenges the long-standing perception of U.S. markets as safe havens. That's all for this video. Thank you for watching. As an independent channel, we don't have corporate backing. We rely on your support to keep going. If you found this video valuable, please give it a thumbs up and leave a comment below. It really helps more people find our work. Thank you so much for being part of our community. Check out the next video on your screen. We picked it just for you.